Hey everyone, welcome back to Corporate Dakota, the place where we uncover the hidden stories behind big business moves and sometimes discover that the emperor has no clothes. Get ready because today we are diving deep into ADT Inc's latest report, and let me tell you, it is full of some interesting borrowing and paying back. Before we jump in, if you love getting these unfiltered looks into corporate finance, make sure you are subscribed and hit that notification bell. Also, we have a fantastic Discord community where we break down these reports even further, so join us there using the link in the description. Alright, so ADT Inc has just dropped a Form 8K filing, which is basically a report for really important company events. Think of it as a company breaking news bulletin. This particular filing is all about some significant financial maneuverings they have been up to. ADT's story here is one of borrowing money and then using that borrowed money to pay back other amounts they owed. It's like juggling debt, but on a massive scale. On the 24th of October of 2025, ADT's subsidiaries Prime Security Services, Borrower LLC, and others entered into what they are calling an incremental assumption and amendment agreement. Fancy words, right? What it means is they are changing their existing loan agreements. They have brought in more money by taking out an additional $300 million. These new loans are called September 2025 Incremental Term B -2 loans. They are basically first lien senior secured Term B -2 loans. Now, what does that mean in plain English? It means this is high priority debt for the company secured by their assets. And if things go south, these lenders get paid back first after asset sales. These new loans have the same deal as the old ones, meaning the interest rates and other terms are pretty much the same, just with more principal amount. So now ADT has about $1.445 billion in these types of loans outstanding. But here is where it gets interesting. They did not just borrow this money for fun. The $300 million they just borrowed along with money from selling some notes and cash they already had was used to pay off a whopping $1.3 billion worth of older debt. This older debt was their 6.250% second priority senior secured notes due 2028. So they are essentially swapping out one pile of debt for another potentially on better terms, or perhaps to just deal with upcoming maturities. This payoff is what they called a redemption, which happened on the 25th of October, meaning the lenders of those second priority notes got their money back plus some extra interest. The total paid out was about $1.3 billion principal plus over $22 million in accrued interest. What is interesting is that while the redemption was on the 25th, the actual payment was made on the 27th. Because the 25th was not a business day, it shows that even large corporate restructurings have to deal with weekends and holidays. But ADT is not done borrowing. Just a few days later, on the 28th of October, they entered into a whole new loan agreement. This one with Fifth Third Bank National Association for a cool $325 million. These are called term A loans. This new batch of loans matures in October of 2030. However, there is a clause called a springing maturity. This means if ADT or its subsidiaries have more than $350 million in other long-term debt approaching its maturity date, these new term A loans will actually become due 91 days earlier. This is a protective measure for the lenders, making sure they get their money back if the company faces a major debt crunch. The money from these term loans is earmarked for general corporate purposes. This is a fairly broad term, but it usually means things like paying off other debts, funding operations, or general expansion. These loans will be paid back gradually. Starting from March 2026, they will make quarterly payments. From March 2028 onwards, the amount of these regular payments will double from 2.5% of the original loan amount to 5%. The rest is due at the end. This is a standard way to structure term loans to slowly reduce the principal over time. Now let's talk about the interest rate. ADT can choose between two options. One is a term SOFR rate, which has a floor, meaning it will not go below zero. The other is a base rate, which is tied to things like the federal funds rate and the prime rate. The interest rate they will pay is the chosen rate plus an additional percentage depending on how much debt they have compared to their earnings, basically their net first lien leverage ratio. Right now they have elected to go with the term SOFR option. This is important because SOFR rates are influenced by broader market conditions. The repayment of these new term loans is guaranteed by ADT's parent company on a limited basis and by most of its wholly owned domestic subsidiaries. On top of that, these loans are secured by the company's assets. This means that if ADT defaults, lenders can go after specific assets to recover their money. The agreement also includes standard clauses about mandatory prepayments and financial covenants. One key covenant is a financial maintenance clause that requires ADT to maintain a specific maximum consolidated net first lien leverage ratio. This is a critical metric for lenders as it shows how much debt the company has relative to its secured assets and earnings. Going back to the second priority notes, the initial report mentioned their redemption that happened on the 25th of October. This was the final step in paying off those notes entirely. The redemption price was at par, meaning 100% of the face value, plus the accrued interest of over $22 million. This completes that specific debt restructuring event. And finally, the filing lists out the actual documents that back all this up. You have the amendment to the credit agreement and the new term loan credit agreement. These are the legal contracts that lay out all the nitty-gritty details of these new loans and debt management. Exhibit 10.1 and 10.2 are the big ones here, detailing all the terms and conditions we just discussed. The report is signed by Jeffrey Likasar, President, Corporate Development and Transformation and Chief Financial Officer. This tells us that these major financial decisions are being overseen and approved at the highest levels of the company. So what does all this mean for ADT? On the surface, ADT is actively managing its debt. They borrowed $300 million and then used that along with other funds to pay off $1.3 billion in older debt. They then immediately took on another $325 million in new debt. This suggests they are refinancing their debt possibly to get better interest rates, extend maturity dates, or free up cash flow. Taking on new debt to pay off old debt is a common strategy, especially when interest rates might be rising or when specific debt instruments are becoming more expensive. The key here is understanding if these new loans are more favorable than the old ones, or if this is simply a way to push debt further into the future. The term loans with their springing maturity and leverage covenants indicate a careful approach to new borrowing and a focus on maintaining a healthy balance sheet. ADT is essentially juggling its financial obligations and looking for the most advantageous way to finance its operations and growth. The company is clearly in a period of significant financial restructuring. One of the main risks is simply the sheer amount of debt ADT carries and the ongoing cost of servicing it. While they are actively managing it, these maneuvers show a company that relies heavily on leverage. The opportunity lies in them successfully refinancing at lower rates or using the new capital to fuel profitable growth that outpaces their debt obligations. Overall, ADT appears to be making strategic moves to manage its debt and secure financing, but the long-term success will depend on its ability to generate enough cash flow to comfortably service this considerable debt burden. Now, looking at these results more broadly, ADT Inc. appears to be in a phase of active financial management rather than explosive growth. Their strategy seems focused on optimizing their borrowing and repayment structure. The new $325 million term loan on the 28th of October, along with the earlier $300 million incremental loan, signals a strong reliance on debt financing. While taking on new debt to pay off old debt can be a smart move to secure better terms or manage maturities, it's crucial to watch if ADT can truly benefit from lower interest costs, or if this is just shifting the burden. The springing maturity on the term loans is a key point to monitor. It hints at potential future financial tightness if other debt obligations become too large. The consistent use of leverage is a double-edged sword. It can amplify returns during good times but significantly increases risk during downturns. The company's financial health hinges on its ability to generate consistent cash flow to service these loans. One notable risk is the potential for rising interest rates, which could make their variable rate loans more expensive, and the increasing cost of servicing such a large debt pile. Conversely, an opportunity lies in using this secured financing to invest in growth initiatives that can outpace their debt obligations, thereby improving their debt to equity ratio over time. Ultimately, ADT's current direction is one of financial optimization, but the long-term success will be measured by its ability to manage its significant debt load effectively and ensure that its operations generate sufficient returns to cover its financial obligations. What do you think about ADT's recent borrowing spree? Let us know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more dives like this. And don't forget to join our growing Discord community. Thanks for watching, see you next time.